something just happened to XRP, and almost nobody noticed. While manufactured crashes were being used to shake out most retail holders, a regulatory filing quietly appeared in the background. Nasdaq approved a listing. For XRP, the ticker is already reserved, XRPC. This isn't speculation. It's written into official filings. But here's the part that matters. This type of listing changes how XRP can be accessed, who is allowed to accumulate it, and potentially, how much of it remains available to the public. I'm not saying this guarantees anything, but if this is the first domino, what follows could reshape the supply, the price behavior, and your own holdings. So the real question becomes, why would institutional finance want XRP on Nasdaq? And what do they gain by securing access to it now? Grab your tin hats, it's time to break it all down. This is FinTech Decrypt. Alright, let's address the question Degen Granny has been thinking, but nobody is saying out loud. Who on earth are these guys? And why should we care? The filing for the XRP listing didn't come from BlackRock. It didn't come from Fidelity. It came from a firm called Canary Capital. And here's what makes that interesting. They aren't a hype-chasing TikTok trading firm, and they aren't launching some speculative, tokenized vibe ETF. They're ETF engineers. Their entire business model is simple. Create a financial product. Get it listed. Let institutional money flow through it. That's how you make money in the world of ETFs. Not by trading, not by guessing price. You profit by controlling the doorway that money uses to enter the asset. And that's what Canary is trying to do with XRP. They didn't file a press release. They filed the exact regulatory paperwork required for ETFs, backed by gold, Bitcoin, Ethereum, and treasury assets. No rookie submits that level of paperwork unless they have legal muscle, institutional custody partners, and intend to push this across the finish line. In the official filing, they name custodians: BitGo Trust, Gemini Trust, US Bank Custody. These are regulated, multi-million to multi-billion-dollar asset custodians. So what does that tell us? Canary isn't thinking about XRP. They're securing the infrastructure to funnel institutional capital into XRP. Because there's a rule in ETF land. The first issuer to market usually controls the most assets under management, permanently. That's why they filed now. Not when XRP is at $10. Not when the narrative is loud. While it's quiet. While retail is scared. While nobody is paying attention. They want to be first. Because whoever controls the doorway controls the flow. So here's the real question. What does this change for us, the holders with skin in the game? Until now, XRP has lived behind a gate. If you wanted it, you had to use a crypto exchange, deal with wallets and custody, sometimes navigate regional restrictions. Institutional money can't operate like that. Hedge funds, pension funds, banks, they are legally blocked from touching crypto exchanges. They can't open a Bybit account. They can't market buy on Uphold. They can't store assets on a ledger. They need a regulated pathway, a ticker. XRPC gives them exactly that. With one listing, XRP becomes brokerage accessible, portfolio eligible, compliance approved. They don't need to understand crypto at all. They can just click Buy XRPC. And here's what people don't realize. Retail buys XRP to trade it. Institutions buy XRP to control it. They accumulate silently, without emotion, and without selling, because they aren't chasing price moves. They're positioning for the next financial system. Here's the part nobody is ready for. A spot ETF doesn't just track XRP. It absorbs it. To launch XRPC, the issuer must buy real XRP off the open market and lock it in custody permanently. Once it's vaulted, it's not trading. It's not moving. It's gone. And XRP's liquid supply is tiny. Forget the total supply. Only about 1.5 billion XRP are actually available on exchanges. That's the entire pool. Retail buyers, payment corridors, market makers, and now an ETF, all competing for the same shrinking supply. Bitcoin ETFs remove supply, but miners constantly create new coins. XRP has no miners, no new issuance, no replenishment. When XRP gets bought and locked, the supply doesn't come back. And when buyers run out of sellers, price doesn't go up, price gets cornered. Let's be real for a moment. Everyone has their own expectation. Some people think XRP is about to explode. Others think it's going to collapse. Many are just tired, stuck in the middle, waiting. So what actually happens from here? In the short term, don't expect fireworks just because news dropped. Markets don't move on filings. Markets move on flows. An ETF doesn't cause price to rise until money starts flowing into the ETF. Could we see a quick push? Yes. We've seen it happen with other assets. Excitement, spike, correction. But that isn't the real story. The real impact isn't a pump. It's a structural shift. Because in the long term, this isn't about hype. It's about accessibility. Right now, nothing dramatic has to happen. We're still early. We're still in paperwork phase. The real move happens when institutions begin accumulating XRP through a regulated ticker and supply starts disappearing. In the short term, price may move a little, or not at all. Long term, the more XRP gets locked away, the less XRP exists on the market, and the more buyers start competing for what's left. That's when price doesn't just rise, it reprices. So here's the part everyone is waiting for. When does this actually matter? When does price start reacting? There are 3 phases. Phase 1, paperwork. That's where we are, right now. A filing, a ticker reservation, and a listing approval on Nasdaq. This phase does not move price, it only sets the stage. Phase 2, activation. This is when the ETF becomes effective and allowed to take inflows. That requires regulatory clearance. Once that hits, institutions can finally buy XRP through a brokerage. This is the moment where demand becomes real money. Phase 3, drainage. The ETF starts buying XRP, and that XRP leaves exchanges. When XRP flows into custody, it stops being part of the active supply. That's when the market feels it. If inflows start slowly, price may move slowly. If inflows start aggressively, supply disappears faster, and price doesn't rise. It jumps. So what's the timeline? Short term, expect patience. Expect silence. Expect the calm before the storm. Long term, as supply gets locked up, the cost of accessing XRP goes higher. Because at some point, it won't be about price targets anymore. It will be about availability. And the moment buyers have to chase the holders, everything changes. So here's the bottom line. Retail had access to XRP first. Institutions are only now trying to build doorways into something you've already been holding. They're late, and you were early. This entire situation isn't about hype, or price predictions, or waiting for someone on the internet to call a breakout. It's about position. ETFs, banks, liquidity corridors all want access. And if supply keeps getting locked away, the question won't be, how high can XRP go? The question will be, how much XRP is even available? Your future advantage isn't timing the market. It's not selling too early. It's holding something others are only now realizing they need. And while we're talking about holding, protect your assets. We don't sell trading courses or shill garbage tokens. The only thing we will ever recommend to our community is protecting your crypto. In the description, you'll find the links to cold storage wallets we trust. Tangem with a 10% discount just for our community. Ledger, the newest devices available. Use whichever fits you best. Not financial advice, just good security habits. Because if XRP becomes the backbone of institutional settlement, you want your keys off exchanges. And you want your XRP under your control. Thanks for watching.